China is using this big demand for physical metal is in the arena of the COMEX, meaning it's commercial 1,000 ounce bars. So even though the retail market can have an effect, it's a flea on a dog relative to the tail of the dog. So once the industrial needs were not met, you saw that the physical market took over the silver price. And that has happened, as I said, very sporadically in the past. This time, it was the real deal. And we saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. We haven't seen those kind of years in a long time. Yeah. Secondly, we saw what happened in January is the price went up 70% in 1 month. Now, I am not here to be an apologist for the bankers.
China's aggressive buying of physical silver on the COMEX, particularly large 1,000-ounce commercial bars, is reshaping the market. Unlike retail demand, which has limited impact, industrial-scale purchasing can directly influence price discovery. When industrial needs outpaced available supply, the physical market began driving silver prices higher. In 2025, silver surged an astonishing 140%, followed by a 70% spike in January alone, moves not seen in years. Analysts like David Morgan note that when physical demand overwhelms paper positioning, price volatility intensifies. As supply tightens and global demand accelerates, silver's structural bull market appears increasingly driven by real metal, not speculation. Now, we present the clips from David Morgan's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Everyone talks about deliveries and the drain of the COMEX. Well, the COMEX actually today, I haven't looked in the last week, but as of a week ago, the start of 2025 had X amount of silver in the vaults in COMEX. January 2026, a year later, there were 100 million ounces more in the COMEX than there was the previous year. Now, a lot of that was steady Eddie. It just stayed level, and then it increased with all the metal coming from the LBMA over to the COMEX. Then we got in that switcheroo, as you recall, and metal left the COMEX back over to London. So right now, what happens on these deliveries most of the time is it's what I call a retagging. HSBC sells to JPM. The metal stays on the floor, in the vault, on the pallets, and the tag that owns it changes. One comes off and another one comes on. It does not move. That isn't to say that the COMEX doesn't have metal that leaves the exchange. It does. But to answer your question, well, where is that stress? You really have to look at what the inventory is in the registered category, primarily on the COMEX, which right now is much, much above where it's been in the past for a low, around 30 million ounces. That was like the lowest I've seen in a long time. It stayed there. It's well above that now. And then on the Chinese market, it's hard to get data, although I am on their website to see exactly where that stress is. Actually, I hate to use the cop-out. I have to see more data, but I kind of need to know. We do know it's at a low. We do know that there's a huge drain, and I would just make an educated guess, Jeremy, that it's stressed right now, and if it goes any lower, there'll be more stress. That's the best I can tell you. A registered is what the dealers have that has the medallion, the tag on it that says it could ship out for delivery. Eligible meets all the requirements, but whoever owns it must make a commitment and sign a document basically that says, I want to turn this metal to a sales position. And a lot of people think that the eligible is held by the banks. Some of it is, but most of it's held by long-term investors that are silver bulls and believes the price is going higher. So the eligible is a separate category. You cannot count as readily available silver. And I don't, but still the registered amount is there. And I'd like to veer off, but I want you to lead. But you know what happens on these margin increases, because I think that's also something that people don't really understand. But I'll give it back to you. I want to be interviewed by you. China is using this big demand for physical metal is in the arena of the COMEX, meaning it's commercial 1,000 ounce bars. So even though the retail market can have an effect, it's a flea on a dog relative to the tail of the dog. So once the industrial needs were not met, you saw that the physical market took over the silver price. And that has happened, as I said, very sporadically in the past. This time, it was the real deal. And we saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. We haven't seen those kind of years in a long time. Secondly, we saw what happened in January as the price went up 70% in 1 month. Now, I am not here to be an apologist for the bankers.
Silver market dynamics in 2026 reveal a complex picture beneath the headlines. While many claim a COMEX silver drain, vault inventories actually increased by roughly 100 million ounces year over year, with significant metal flows and COMEX. Much of the reported deliveries are simple ownership transfers, metal re-tagged inside vaults rather than physically moved. The key metric remains registered silver, which is available for delivery and currently sits well above past lows near 30 million ounces. Meanwhile, strong Chinese demand for 1,000-ounce bars and tightening industrial supply helped drive silver up 140% in 2025 and 70% in January, signaling powerful physical market influence. Let's get back to the interview.
Well, people are going to hate me. And, again, I'm not a lover of the bullion banks and the banking system at large. Let's keep that on the record. But banks do not like risk. So a lot of this idea that the banks are massively naked short just is not true. The bullion banks basically control the market. How do they control it? Through physical metal that they leverage in the futures exchange. And is every one of it covered and not naked? No, they are naked short. However, not to the level that people believe or are taught or told over and over again. Most of that metal has, some backing to it. Again, it's not a one-to-one. Having said that, it's the commodities trading funds. It's what we call the opposite of the commercial, the banks, and it's the public that are basically doing the nakeds. Not all of them, of course. So the balance between the longs and the shorts have to meet. There's a winner for a loser. There's a zero-sum game. The banks almost always win, but they're not as leveraged nakedly as it is touted to be. And this is something that I guess people just don't understand or want to believe that. They want to make the banks the bad guys. I kind of do, but I also want to be as objectively true as possible, and they are not nearly as leveraged as it's been out to be. In fact, if you go into the COMEX, you look at the open interest and you look at the amount of silver that's on there, instead of 100-to-1 coverage, last time I looked, it was 6-to-1, not 100-to-1. That was futures only. If we throw in options, and I didn't do the math because I didn't really want to bother, but it might be 10-to-1. So this idea that now that doesn't account, to be fair, what's over in the LBMA, which is outside of the system, which there's forwards are called. This is like futures, and that's a paper contract. So there's probably more than what I'm indicating. But this idea that there's 100-to-1, that kind of leverage is gone. And it's been gone for some time. I think the people that know the most, which is pretty much the bullion banks, know what the actual supply demands are and how stressed the markets are. And knowing that, are you going to go overboard in the leveraged arena? No, you're not. You're going to cut back and make sure that you're not going to be in trouble. Very light trading. The banks would come in and throw massive amounts of paper, massive amounts of contracts, and they push the price down. And that would start the algorithms saying, oh, margin call. It'd open up in New York, and it would have a big follow through where you get a lot of downward pressure on the market. And that's happened again and again and again. Now it's a little bit of a different story because the physical demand is really dictating the market, even though we had this big move in January. And honestly, I told, publicly and privately on my premium service, look, I'm getting worried. This is almost double parabolic. And I don't care if it's soybean oil, cattle futures, or silver. When it goes up that fast, that high, something's got to give. Be prepared for a correction. And of course, we've got one, and everyone yells, well, it's manipulation. Actually, it's normal market activities in the futures market. I defy anyone to prove me wrong on it. The CME, the exchange is really the most responsible party. And if they see problems in the market, too much enthusiasm, let's say, they will increase margins. And this is to protect everybody. Now, of course, most of the silver people think, oh, they're doing it on purpose. I wrote on X that margins will be increased again and again and again until the market subsides, until I might have even said comes down or peaks out, whatever.
Yeah.
Because that's the way it works. And they do that to protect everyone, actually, themselves, of course, because that's what they run. But it's not really as evil as people think. And so I want to do a real quick thought experiment with you, Jeremy. I thought about this my first cup of coffee this morning. You know, what I've advocated for in the past, and I still think might be the best, I'm not sure, is a cash only market. Just to digress slightly, the egg market and the milk market used to be in the futures markets. It doesn't exist, hasn't for decades. But they are both cash markets. We still go to the grocery store and buy milk and eggs. You could have a cash only market in silver. Now, think about the margin thing. If my margin goes up from 10% to 20% to 30 to 40, what if I go to 100% margin? I'm now in a cash market. So if you really think about it objectively, the harder the margins go up, the closer we're getting to a cash market, which gets rid of my favorite expression, who's who in the zoo. Who are the guys that are on very thin margin that are weak sisters that are going to get flushed out anyway, that don't know what they're doing, never traded before, or just aren't, thinking through this market. So the higher margin goes, really, the more we're forcing a cash-only market. So I wanted to get that into the record because it's an alternative way of thinking about it, the way the mainstream silver bulls think about how the futures market works. So I just wanted to make that comment. I like your feedback.
The silver futures market is often misunderstood, with many assuming bullion banks are massively naked short. In reality, banks use physical silver to manage risk and leverage contracts, and their actual exposure is far lower than widely claimed. Open interest on the COMEX shows futures coverage closer to 6 to 1, not 100 to 1, while options may bring it to around 10 to 1. Physical demand is increasingly driving prices, particularly with industrial and Chinese purchases. Margin increases by exchanges act as safeguards, effectively pushing the market toward a cash-only system. Analysts emphasize understanding fundamentals over blaming manipulation in silver's rapid price moves. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.